Good evening, everybody. Hi, Harry. Hi, Hasini. Hi, Lauren. If you could just confirm you can hear me okay, that would be lovely, even if it's in the chat or with your audio.
Yeah, we can hear you, Liz. Hi.
Oh, lovely. Hi, Hasini. How are you?
Good, good. How are you?
Good, thank you. Just got a couple more coming along, just joining. So we'll just take a minute just to let everybody in. So welcome, everybody. Got Jay Quinn, Rian. Who else can I see? Alyssa, welcome, everybody. Lovely. Thank you to those who are reassuring me that you can hear me and you're all getting connected and set up, which is lovely. I'll just wait just a little bit just to let a couple of other attendees come along and get settled. And while you're waiting, thanks, Alyssa, for using the chat too and saying hello and getting that started. That's fabulous. Just to get started, it's lovely just to check in and connect with you all and get an idea of where you're geographically located. We're all connecting in from different parts of Australia. So if you wouldn't mind, gets you familiar with that chat function as well. So jump into the chat if you can and just pop in where you're from. If you'd also like to share what you're studying, that would be fabulous as well. Gets us a little bit of opportunity to get to know each other. Great. Thanks, Harry. Welcome from Geelong. Alyssa's in Lismore. Lovely. Hasini, you're on the Gold Coast. Fabulous. Rian, Gold Coast as well. Fabulous. Navi is in Melbourne. Lovely. So you're coming up to the Gold Coast next week. That's cool. Very good. Are you relocating completely, or is it just for a short stay or a practical that you've got to do? Oh, you hate Melbourne? Is it the cold? It's been a pretty cold winter right here, so I'm sure it's probably part of it. Okay, cool. Thanks, Alyssa, as well. Sharing that you're doing your master's in plant science. Very cool. Yes. Navi sharing just her hate of Melbourne and all the different changing of weather. I know I used to live in Melbourne, so I understand. But I now live in northern New South Wales as well. So between the Gold Coast and Lismore, I hope you enjoy the Gold Coast. Lovely. We've still got just a couple more students. This has been a really popular webinar, so I'm really excited to be running this one tonight. We had about 50 students register. I'm not expecting that many, but we've just got a couple more joining. So thanks for everyone's patience just getting settled in. So very cool to get an idea of where you're all from. So anyone who's just jumped in, you can have a little scroll back at the chat and just get an idea of where everyone's from, which is fabulous. It would also be really nice if everyone could share, maybe if you're happy to, what you're hoping to get out of tonight's webinar as well. This is a, starting from the foundations webinar around investing. So we're going to be right back to basics. So it'd be nice just to hear from a few of you in the chat, if you'd like. Just let me know what you're hoping to get out of tonight. That would be fabulous. It's great. We've got about 10 of you here already. So welcome to some of the new ones. Sorry if I've missed your names. It's a bit hard, on the tile to keep track of everybody. Odangunga, I hope I'm pronouncing that correctly. You're from Canberra, so hello to Canberra there. Be chilly for you as well tonight. Cool, thanks, Rian. So you're looking at a little bit more information about shares versus property, so we can have a bit of a chat about that. I'm just going to take a couple of notes here just so I make sure I can intertwine some of the things that you're particularly interested in, if I can cover those. How to get rich, lovely. I can speak to that one. Everyone's, yeah, Alyssa's giving that one a clap as well. Very cool. Hasini, some investment tips, including selecting the best banking products for savings, etc. Yeah, very cool. Yeah, we can have a chat about that. For savings. and Odangwa, I'm pronouncing that. I'm so sorry, I'm pronouncing that wrong. Shares as well. So we've done it. That's cool. So that's great. Fabulous. So if anyone else has anything else, yeah, feel free to pop that in. That's really great for me just to get a sense of what everyone's wanting out of tonight. So we'll get started, and really nice for a group size like this of 10 of you. If you would like to just, as I'm talking over the next 55 minutes or so, please use the chat to ask any questions if something I've said doesn't make sense or you want me to go into something in a little bit more detail. You can also turn on your microphones as well if you're comfortable. You can put your cameras on or off, it's up to you. I can only see a couple of you at a time with the tiles, but I also appreciate that this is a time when life is also usually pretty busy in a household or if you're traveling from work. So it's also cool if you just want to use the chat. Harry, thanks. You just added a couple more. You're looking some information about mutual funds, stable investments. You're investing in crypto. Okay, I was glad somebody here is, we can have a chat about crypto as well. It's not stable. So this is great. And I might actually call upon you if it's okay to share some of that experience. So sounds like you already had, when I ran this webinar last year, we had somebody attend who had been investing in crypto, and I can share a little bit about their experience. It sounds similar to yours. So you're saying it's not stable. How has that experience been for you? Has it been quite stressful, the highs and the lows, the roller coaster? Have you lost money, or is it, are you up? But we can certainly have a look at talking about some of those cryptocurrencies. And I'll definitely be talking about long-term, stable, what I call academic investing, and really encourage you all to do that. So that's cool, very cool. So yes, please interrupt me in the chat via your mics if there's anything that you want to go into. There'll be chance at the end, space and time for us to have Q&A, and also an opportunity for you to get in touch with me if you want to talk to me one-on-one. We've got free time available. SCPA has engaged me to be able to work with you one-on-one as well for free for you guys. So yeah, just know that's an option. Okay, cool. Thanks, Harry. That's awesome. So yeah, we'll definitely touch on that when we get to it. So officially, welcome everybody. Wonderful to have you here. So pleased everyone's so interested in this topic. And also, as I said, we've got a lot of people who have signed up to this webinar. So they'll be listening back to it. All of the webinars are recorded and they're available on the SCPA YouTube channel, which you'll get a link to after you've attended as well, and also to all of those who signed up. So tonight is all about investing made simple, but it is really a foundational webinar. We've only got just under an hour, so we're not going to be going, this is not a finance course, but I'm hopefully going to give you some really important, helpful information, but obviously we could dig a lot deeper. I appreciate that you're all studying different things, come from different backgrounds and fields. So I'm trying to create a baseline of not overwhelming, not discouraging. So I'm going to keep it hopefully in just simple English, plain communication of key concepts that you can really walk away with something that's helpful, but hopefully will spark an interest that you might then go from there. And I've got some different resources that you can go to if you want to then obviously continue on with some of what you've learned tonight. So a big welcome to you all. This slide is always to prompt me to just recognize all the incredible work that you're all doing from different backgrounds. And yeah, all that wealth of knowledge, amazing work that you're doing, but also to recognize all those skills that perhaps you think you can't or don't translate into your financial life. They do. I like to remind everybody of those critical thinking, analytical skills, communication skills, decision-making, strategic analysis, all of those skills that you'll be using in your studies are really important for when you're managing your money, and you can bring those skills and attitudes and perspectives to your financial life. Often we bring a different part of ourselves to our financial life, but it's nice to kind of think, yes, actually some of what I'm learning and the approaches I'm taking in other parts where it might be working really well. Maybe you have a relationship with money that you think could be improved. Maybe consider some of, the approach you're taking to your studies and your work and your career may actually be really useful in your financial life. So but thank you for all the amazing work that you're doing. Quickly, my name is Liz McLardy. I used to work at SCU teaching accounting units. My area is strategic management accounting. So I'm a fellow CPA, and so I am an accountant, and what I'm bringing to you tonight in terms of investing is from an accounting perspective. So it's conservative, but it is solid, stable, some of what Harry certainly was sharing that you're looking for. And I think many of you, it's not a quick rich approach, but it certainly works. So yeah, it'll get you thinking. So hopefully you'll enjoy it. So yes, education and accounting and finance is my area. I've also got a financial counselling qualification as well, hence why I also partner with SCPA in that capacity as well. So the key really is with these webinars and working one-on-one is the hope is to help you to all feel more confident financially with your financial decisions, and obviously investing is a big part of that, so that you can then focus on your career and your studies, and that's why you're at SCU, so it can kind of free up that cognitive space to then allocate it to that, as opposed to getting drawn worn out by your financial worries and concerns. So hopefully this one will help tonight. The goals of today, so tonight what we're going to look at, 4 kind of key things. I'm going to introduce you to some of the basics of investing, and as I said, some of you will be coming in with different levels of knowledge around this. So for some of you it may be brand new, for others you may have heard it already, but it might just be a good refresher. I want you to just have some of those basics in terms of investing, understand where investing fits in with your broader financial plan. What role does it play in terms of all the different things we can do with money? Investing is one of them, but where does it fit in? When is it a good time to invest? Those kind of things. Have a bit of a chat about superannuation as well. So for all the Australian residents or people working in Australia, you'll be earning super. Just to give you a bit of a heads up around that as well. Obviously, that's a key part of our investing, and we often forget about it. But if you're working, you're investing because you'll be earning superannuation, which is really good. And then looking at building investment strategies outside of super as well, and what are some of those, what are the options? And hopefully I'll cover off, as I've just noted as well. So we're looking at comparing some of the different assets. We're going to go into talking about those, like shares versus property. We can have a chat about some of the best banking options as well for savings, what would you be recommending, and have a bit of a chat about shares and crypto as well. So Hasini, I've just seen your message there too. So you're just sharing, if you're not a SCPA member, to be able to join up as well. That's cool. So thank you for sharing that. That's fabulous. So to begin with, going right back to basics, just understanding, what is investing to begin with. So it's really about using your money to buy an asset that will then grow in value or generate income. So if we think about simple assets, and I've got a lot of different options here in terms of investments, but if, as from an accountant point of view, we're thinking about assets, we can think about, say, for the example of a car. Typically a car that we're using, an everyday car, Toyota Corolla, is not an investment because its value declines as soon as you buy it, pretty much. So it's a depreciating asset. However, if you were to invest in, I'm not a car person, but I know that there are cars that you can invest in that do appreciate in value because they're rare, if they're well maintained, all that kind of thing. That's then an investment. So you can see how the same asset type can be, in one circumstance it's not an asset, it's an expense to you, and it's a depreciating asset, so it's losing value. What we're wanting to do in investing is buy appreciating assets. So they're either going to grow in value or they're going to give you an income source. So as some of you already shared, you already touched on some of the different asset classes. So the key starting one is superannuation, which is essentially, in its most basic sense, when you're working somewhere, you'll join that company. They will have a default fund, which is a managed fund of stocks So little parts of old sorts of businesses that you would then have that money contributing into. So you can already join the existing funds, or you can have a look around and choose your own. We'll have a little bit more of a chat about superannuation further along tonight, but that's kind of the basics. There's obviously more complexities to that. If you've got your own self-managed super fund, you can, own businesses in that super fund or different types of property. So you can do that in that entity type. But I think we'll just keep it to basics in this session, and just assume that when we've got our superannuation being paid, it's being paid into stocks managed by a superannuation fund. So stocks and bonds, so stocks are parts of businesses, as I said. So it's likely that you'd all have some of those. Does anybody own, so Harry's talking about crypto, but does anybody else own any individual stocks? Perhaps sometimes when you're working for businesses, big businesses, they may give you through an employee share plan. If you work for Woolworths or Coles or even airlines, they may give you shares. Banks do this a lot as well, as part of, like a remuneration strategy. But essentially what you're doing is buying a small part, owning a small part of that business through buying the stock, and then some of them will give you dividends, so distribute some of the income or profits that they make will then go out to the owners, and some don't. So in themselves, so these different types of investments, as I've got listed there, we could do a session or a couple of hours on each of them individually. So I'm not going to go into it in massive detail, but in terms of, you'll have different types of stocks. So some are those, if we're thinking about this definition of investing, some are ones where you kind of holding them for them to grow, and others will generate income. So they may not grow as much in value. The value of that stock may not increase, the price of it, but they may be generating income through dividends. So you do get, even in this bundle of stocks category, you get lots of different types of stocks. So just know that there's a whole range. And the same goes for property. So it's its own asset class and type of investment. So we can easily think of people who own investment properties, individual properties. If you've bought a townhouse, an apartment, or and you rent that out, again, you could be having it generate an income for you, or you may also have a strategy around it to hold it, to see its value increase so that you can then sell it, and then obviously that increase in price and value is what you gain from that investment. So in that property bucket, yes, you can have individual properties, you can have residential properties, so those that you rent out for people to live in. You can have commercial properties, and then you can have funds that also then more like a managed fund, where people are managing stocks or investments into multiple types of property. So it might be so it's more of a managed scenario. So that's, again, broadly high level, another option in terms of investing there. You can also invest in indexes. So obviously we have indexes in Australia who might take the top, 200 companies in Australia, and you can just invest in that index, and the same goes for all around, you've got the New York Stock Exchange, London, etc. You've got those, so you can invest in those indexes, and we're going to talk a little bit more about those as well, because they can be quite useful and quite a good stable way to be investing. You can also start investing in yourself by, obviously you're studying, but you may be working towards creating your own business, which is another great investment as well. Worked with a number of students who, whilst studying, are building up a practice and help them do some of their business modelling. So that's very cool. So you can invest in your own business and again, generate an income from that, and also establish a business that you could then sell for a profit at the end of the time that you wanted to run it. So that's where you're getting that wealth generation as well. So hopefully that helps kind of cover off some of those I think it was Eliza who asked about the different, I'm just going to forget who's asked the questions, I'm sorry, but just let me know if I haven't sort of answered your questions in terms of those different asset types. But as I said, I could go into a lot of detail into each of those individually. But just a quick question. I know that so Harry shared a little bit there. Is there anybody else who currently invests? And if so, what type of assets that they invest in? It'd be great. Thanks, Hasini. Not in Australia, but you're invested in a business, exporting business. Oh, sounds very interesting. Okay, cool. And lovely. Love to say that you've also got superannuation acknowledged as an investment too. Often people forget about that. And Eliza, so you've got a small amount invested in CommSec shares. So is that just there, or is that the share trading platform, or are you invested in different shares, or is it just Commonwealth Bank shares? Okay, cool. So a little bit of crypto as well. And Hasini, it sounds like you've got quite a portfolio in terms of your investing, which is great. And very cool. Good to kind of sort of sit down and think about, what are you aiming to, because and we'll come to this as well, as thinking about what role is, your investing playing in your whole sort of financial landscape. So knowing what the goals are of the different investments, or what timeframes you're looking at, and that can be really important as well. Okay, cool. So thank you for sharing that. Just again, at this stage, okay, sorry, just jump onto Harry's question here. Want to invest in mutual funds, index funds. What are the steps to proceed with this? A temporary resident. Okay, and I need to look specifically around the temporary resident scenario, but if for just, generally, if you're going to look at investing in mutual funds, index funds, Vanguard are a really good place to start and have a look at. They're global, but they do obviously have, locational things as well. So they provide a lot of different options around index funds. They're very low cost, and they have kind of mutual funds within them. So they have managed indexed funds as well, which would be really useful to look at. So that's what I would probably look at. But happy to connect with you one-on-one and have a look at what some of those temporary resident options are, and what if there are any restrictions. So yeah, we're happy to take that one offline. And Eliza, thanks. So it's in the sustainability leaders through CommSec. Okay, cool. So I don't know if I know particularly what that is. If it is just Commonwealth Bank, have you bought individual shares, or perhaps I'm not quite sure what that is, but I'm going to assume that's individual shares that you have in Commonwealth Bank. And we can have a little bit of chat about what the difference is between investing in individual shares as opposed to, like Harry's asking about, mutual funds and index funds, etc., and getting that diversification. So before we kind of jump into what I want to share with you first is, what are all of the options? What are some of the key, I guess I'm going to cover here in the next couple of slides, the basics to investing, and then we'll start to look at what are some of the options and compare them. So one of the, as I've got it on the screen, is investing's best friend is time and consistency. I think it was Hasini who was asking about get rich quick, possibly, so which is something that I'm definitely not about. What we're obviously here is saying time and consistency is investing's best friend, and you just got to look at Warren Buffett and his story and journey to understand that. But one of the key investing, concepts is dollar cost averaging, which is what I share, which is all about, so it's not about trying to time the market, trying to think about, okay, when do I buy particular stocks? taking that stress away of trying to judge and pick the market. No one's got a crystal ball. It's impossible to do. So rather than doing that, it's about investing regularly. So investing a fixed amount. So if you can invest a fixed, maybe you get paid fortnightly. So you work out, based on your budget, how much of that you can put into investing, that you have that automatically coming out and being invested at that regular interval. So it doesn't actually matter if the market's up or down, doesn't matter what's going on, because it avoids that risk of you trying to time the market and putting in a lot of money in at, trying to time it with a lot of money is quite risky. So it's lowering the average cost per share over time, because you're just investing little bits frequently and regularly. So it's that consistency. So you don't need to have that pressure to think that you're going to be an expert stock picker. Unless you're studying finance and have been doing that, and something you really enjoy doing, you don't need to do that to be successful in investing. You just need to start as early as you can. So that's the time element. Time in the market is what makes a difference. Contribute regularly, so that consistency, and then let time do the work. So I know it can be frustrating for those who want to get rich quick, but it will soon to as your returns also start to compound and grow, you're going to really see the benefit, all of that. Hasini, I was just jumping on to just read your comments too. You've got to focus as a couple of investment options covering low and high risk. Okay, cool. Looking at some of the different things in Aussie. Looking at what you can do with your super and increase scope score. Okay, cool. We can have a bit of a chat around those things too. So that's really a key takeaway to if you have these people who and it's all stories, and I know it can be, because we've got two people who've invested in crypto here as well and have jumped on that. Obviously, but perhaps be keen to know how you got into it. Was it that you heard somebody, family member, friend, who had potentially made a lot of money, and that it's hard to resist, but it becomes a bit like gambling, because you're just jumping in and give it a go kind of thing. The better thing to do is dollar cost averaging, invest a regular amount frequently, and let time then be your friend. And then the big thing is what do you invest in, and we'll have a chat about that. With any investment, there's obviously a balance between risk and return, and Hasini's already shared there, which she's looked at a couple of investment options trying to cover off those that are low risk with high risk, which is very sensible. And that really speaks to sort of my last point on this slide, which is around diversification. So yes, having diversified investments spreads that risk. So you're not just investing in one particular asset, even one particular asset class. So what I would speak to here really is, if we think back to a couple of slides before, we're looking at the different options. From the most risky thing to do with your money would be to just put it in a bank account. Well, one of the most risky things is if you've got extra money that's just sitting in a bank account, not a high interest bank account, it will be losing money, because as we know, we have CPI, which is the amount that everything goes up. Price of everything goes up year on year. So essentially $100 today is going to buy less in a year's time. So you don't just want that $100 sitting in your bank accounts. That's the worst thing that you can do with it. Hasini, if you do have an emergency fund, and I'm going to talk through some of the key 6 steps to follow in terms of having really good foundational finance. And one of those is to have an emergency fund. And that's a really good place to park an emergency fund, is a high interest savings account. So all of the big banks have them, even your online banks like ING, Rabo, they'll all have a high interest. You might be getting around 5 to 6% on that. But the key thing there is that money is available to you. It really stops you from going into debt. and allows you to manage, the twists and turns of life that do happen, and take away some of the stress around money. So it's a really good place to park an emergency fund. And I'll talk about how much that would be, to give you an idea to work towards. So that's low risk for a amount of money that you want to be able to access and not be worried about. You may not know when that twist or turn may come, so you don't want it invested in even index funds, which I would recommend, because at that particular time it might not be the right time to sell those index funds, because you don't know what's going on with the market and you don't want to have to be timing it. So it's reasonable to have some money parked in a reasonably low risk, high interest saver, but not just your normal bank account, because that's bad. One of the highest risk investments would be cryptocurrency. We don't know what it is. Does anybody know what they're buying? One of the key things as an accountant is always knowing what your asset is, investing in things that you know and you understand. So if you're buying shares in, Elisa's got Commonwealth Bank shares, you know what that bank is, you know what it does. It has buildings, it has employees, it delivers services, you know what it does. Even a currency of a country, you know what that is, you know what that country does, you know what it produces, etc. Cryptocurrency, I really love to hear what everybody thought they were investing in. So it's just a gamble, and I would definitely avoid that altogether. But what you'd want to do is, look at the different asset types. Some people will have a natural affinity, or you may come from a family who's used to, sounds like Hassini has lots of different investments, and property was one of them. If you're somebody who enjoys that, having one property, putting all your eggs in that one basket of having one property that you manage and get rental income from, is risky on its own as well, because you're putting all your money into that. That's kind of, and I'll, Siddhartha, I'll come back to as well, with some of the other questions you guys have got as well. So it's working out, making sure that you've got diversification. That's the key to reducing the risk. And this may not be the image that everybody wants to see when they're thinking about money. They want it to come quickly, they want it now, they want more. But the key thing is the slow and steady. So diversify your investments, spread them across lots of different asset classes to reduce that risk. Investing in low cost index funds does that. Although if you were to look at the top 200 companies in Australia, they're heavily in the banking and finance sector. So it would also be worth looking at, going to, and I've recommended Vanguard. They're a low cost investment house, and they then allow you to invest in ETFs, so exchange tradable funds, that are actually index funds within index funds. So you get a little bit of exposure to international markets. You'll get the ability to diversify within the one index, and they have them based on balance, conservative, growth, high growth, and give you that information about matching what fund is appropriate depending on your time horizon. And that's usually the biggest thing in terms of when we're looking at risk and return. You can take on a little bit more risk if you've got a longer time horizon for your money. So if you have it's being clear on what the purpose and strategy, long-term strategy or vision is for particular buckets of money. So, and you need to kind of know at what stage you are. A lot of time that people are trying to do a whole lot of things at once, but it may be just knowing that, if you're working and you're earning, and you're obviously then earning superannuation, that's 12% coming in. Ideally, if you can put aside, 15% for your long-term retirement, that's then being applied for. If you're your next thing is that you're wanting to buy a house, you're wanting to save up money for that house. Again, the time horizon, if you know that you can save up enough for a deposit within the next 5 years, but you're going to use it you want it to be in a high interest saving account, because again, you don't want to be trying to access it, if the market goes low and you have to sell your index funds. But if you've got a time horizon of larger than that, going out 7, 8, 10 years, you can be doing different things and putting it into somewhere you're going to set and forget it and just keep adding to it. So yeah, focus on low-cost index funds. It gives that, as I said, broad exposure to markets with lower fees, and it reduces the impact of just choosing individual stocks. So don't try and be something that you're not. And even people who are highly trained in financial analysis still don't outperform the index funds most of the time. So having just one stock is again quite risky. So looking at selling it and moving it into a more diversified investing would be a good move. So yeah, long-term perspective, decades, although everyone doesn't want to hear that necessarily. Steady investments that has that have also have that history of delivering consistent good returns. So as I'd shared before, just a couple of try to make this as simple as possible, sort of the steps, depending on, I'm not sure where everyone's at. I'm not expecting you to share it, but everyone will be at a different stage of their financial life. So these are just some smart steps to kind of build a good solid foundation. So it just depends on where you're at. But first off, to have a starter emergency fund of $1,000. Why $1,000? Because most emergencies, like if you need something happens to your car, your washing machine breaks down, is usually covered by that $1,000. And what that does is prevent you from going into debt if you don't have the money. So again, this is really broad. I don't know if everyone's situations, but that would be the sort of starting principle. Make sure you've got $1,000 sitting in a high interest saver. The next focus then is to pay off all of your consumer debt. So what you're already hearing so far is investing isn't even something you should be considering if you have consumer debt. So you need to make sure that you focus on that first, because essentially what you'll be doing is that you're borrowing to invest, and that's very risky. So you need to make sure that your priority is just working through these steps. Firstly, building up the emergency fund, paying off your consumer debt. So HEX is different. So we can chat about that a bit later, but that's not in this bundle. But any personal loans, car loans, credit card debt, pay now, buy now, pay later schemes, any of those, that is your priority. So make sure that they're all paid off first. Once all of that's clear, you're not in debt anymore. It's about, and in your house, if you have a home loan, is outside of this. So that's not in the consumer debt bundle. So it's just what I'd shared before. After you've got that consumer debt paid off, the focus is then on building 3 to 6 months worth of expenses. So increasing that $1,000 up to 3 to 6 months worth of expenses. So depending on your lifestyle, what you're up to, working out and having a good sense of how much do I spend in a year is a really good thing to go through, because having all of this behind you before you make any investing decisions is going to then ensure that your investing is going to be successful. You're also going to do it from a really strong position, and it's going to really build your wealth rather than create stress. So build up that 3 to 6 months worth of expenses, and then start to look at growing your wealth beyond your super. And so 4, 5, and 6 here are really things that you kind of do together. So you'll be potentially saving for a home at this stage as well, depending on where you're at. Or you might be wanting to do further study or build a business. And then from there, you can also then, once you've saved for your home and you've paid it off, you're then in a really good position to start looking at, how can I actually give money? How can you continue to then grow it and invest it for the long term as well? So hopefully that's helpful, just as a quick guide in terms of where you should be focusing depending on where you're at. So just a couple of pointers to those who want to jump straight into investing and feel like it's the thing that they should be doing. It depends on where you are in that list. So anything like high interest debt, it has to be eliminated first. Having money for emergencies gives you that cash buffer, which, as it says, it prevents you from going into any further debt. And it just gives you peace of mind, which we often forget about as being a big part of wealth and financial well-being. So there's a lot of stress that comes with taking risks, and we often don't think about that, or we're thinking of the dollar signs. So it's about that slow and steady establishing a really solid foundation first and putting yourself in that and your family into the best possible position. A little bit about superannuation, just to get your head around it if you are not familiar with it. So it is in Australia, our retirement savings plan, and it's recently, the employer's contributions just gone up to 12% of your salary. So anybody earning money here will be having that 12% contributed to an investment superannuation fund. As I said, you should be looking at the fund that is the default one. Often people just tick the box and go, yep, happy to go with that one. Make sure you don't have more than one superannuation fund. The fees will erode any investing gains that you're getting. So make sure that you combine them. If you've just maybe got a new job and you've still got an old super fund, roll it over, or look at both of them and decide, which one is performing better. Take that little bit of extra time. This is really an important part of your wealth building as well. We just forget about it because it's invisible and it just gets done automatically. But there is a very big difference in the superannuation funds, what they charge, their fees. So really important to be looking at those. At the bottom of this slide, and I've got at the end of the webinar as well, is somewhere you can compare the super funds. So it's an ATO tool. So it's a credible source. It's not somebody trying to sell you things or manipulate the data. It is objective and helpful. So yeah, have a look at comparing your super funds and make sure that your fund is working for you. You can change them at any time, and you don't have to go with the one that your employer's default is. You can't access these funds until preservation age at 60. So depending on what your outlook is, what your position is, what your goals are, if you're wanting to retire before that and you're able to, and you're in the position to, you're going to need to then build up investments that you can then access that money or the income. So if you say want to retire at 55, you'd want to make sure that you're making that calculation around, well, how much do I need to bridge that gap between 55 and 60? What are those investments? What do they look like? And will my super fund have enough in it to then fund me? So if you're not sure about that, again, it's looking at what are some of the investments that I need to start looking at, and how much money do I need to be putting aside for them, etc. As I mentioned before too, there's a lot of different investment options inside your super. So have a look at those for your individual one. Find out what are the different, and even often they have free sessions that you can connect with to get information about them. And definitely, because depending on your age, it will then determine which kind of investment you want to go into. As you get older, your appetite for risk gets lower because the investment horizon gets shorter. So if you're young, it's likely you'll be putting something into growth and high growth, which is more risky, but it has that longer term horizon. But look at them all carefully, and you need to be informed and make those decisions. And you can choose to make an investment mix depending on which fund you're in. So it's a really great compulsory and powerful investment tool here in Australia. But yeah, it's just knowing that depending on how old you are, it is a locked box. So you can't access it until preservation age. But yes, please, if it's one thing that you get, I guess, you feel encouraged to do after tonight's session, is go and check out your super, make sure you know all about it. That would be a very good action to take out of tonight. So the big question of, many of you have already shared that you are investing, but it'd be interesting to know that even based on what I've talked through there, When are you ready to invest outside of super? Is when all of your consumer debt is paid off. You've got a 3 to 6 months worth of expenses saved up as an emergency fund. Your budget is also stable. You're very clear and well aware of how much income you've got coming in. You've got a good grasp of your expenses going out. Then you're in a good position to start investing. So that only then would I be saying yes, okay, because you'll have a clear idea of, is it $50 you've got each week, or is it $100, and are you clear on that? So we'd be keen for everyone in the chat too, if you're happy to sort of say if you are investing or not. Are you in the position based on this to invest outside of your super? How many of you are? And probably the big one I would expect is around having this emergency fund. That's usually the piece that perhaps people haven't got stashed away. Okay, cool. And Eliza's saying you are, yep. But the budget's hard to estimate. Cool. Yeah. And I know particularly at this stage as well, if you're studying, it may be that you're in it's kind of a season that's slightly different. So maybe this isn't the season to invest, because if you're not working as much, but once your study's over, you'll be able to go back to work full time and perhaps be at a higher level. That's going to be a good time. So Harry, just asking to repeat it, I think. Yeah, no worries, Harry. So I'm just asking if, based on these kind of prompts on the screen at the moment on my slide, are you in a position to invest? So is all of your consumer debt paid off? Do you have 3 to 6 months worth of expenses saved and in a high interest saver? Is your budget stable? So you've got a good understanding and grasp of your money. You've assigned every dollar you earn a purpose. You track it. You know what's going on. So Harry's saying the first one, maybe not. So it sounds like you've got consumer debt that you need to pay off. So that would be your focus for sure. And Hassini, you're saying yes, but it sounds like there's a little bit of wavering confidence there around your budget and getting that more stable as well. So, and again, I don't know if that's, just this season whilst you're studying. I would certainly want that to be stabilized before you sort of jump into investing. I know it always sounds so sexy to jump in and make money, but all of these foundational things, those things will just not be enjoyable if you haven't got these set. Okay, great question, Eliza. So you're asking if it's worth starting now with very small weekly amounts for investing, or better to wait for more substantial contributions. And my response would probably be more about, how stable you feel like, all of those other elements are. Even if you have, I can't remember if you'd shared, if it's like $50 a week, you can certainly, so for example, the Vanguard accounts that I was discussing, you can certainly set up an auto invest. I think the starting amount might only be $200, and you can make small contributions, and definitely consistent contributions. Time in the market is definitely of value, but it also depends whether the rest of your financial scenario. So I probably couldn't make, and I can't give you advice, but I could, if I was in your shoes, what would I do? I'd probably need more information about your whole landscape. So do you own your home, or do you need to save up a deposit for a house? What other goals have you got in and amongst all of that? Because it might be actually worth, if you've got a little bit of buffer in your budget, yes, letting that build up, and maybe that would be for something else. Maybe that's for a home deposit instead, particularly if you're working at the moment and you're getting your 12% superannuation. That's also good. So I didn't really answer your question, but it gives you something to think about. There is a lot to consider. Yes. That's why you've really got to take on, really important when people, you hear others, and this is a big thing for finances, people will make flyaway comments about what they're doing or how much success they've had with something, but you do not know their whole financial picture, and you won't, because it's invisible and it's personal. So all you can do is also, and people don't know yours, so you've really got to look at your whole financial landscape and your goals and objectives, and work within that. That's really important. So yeah, there is a lot to consider. But happy to help you just structure some of that thinking as well if you want to, on a one-on-one basis. Yeah, more than happy. Love doing that. The big question, and you're also talking here about, how much should you be investing? Again, this is really general, but sort of a guideline is aiming to invest, somewhere between 10 and 20% of your income for retirement, that would be. So, and a lot of the research kind of looks at, an amount around 15%. And great that we've already got that 12% going in from our income. So that's kind of like a guideline. If you're new to investing and obviously have ticked off all of those points from that previous slide, you can start with small amounts like Elisa's looking at, and slowly increase it or stop it, depending on the twists and turns of life. As I say, if things start or stop, or, you have a family, you stop work, for a bit, or you as you're doing now, you're studying and your income reduces. So it's knowing that our financial life and our budgets are often changing, but as long as you're updating them and responding to it and not letting it kind of rule you, but you're sort of staying in that driver's seat, and making, decisions based on where you are, what's changed. Okay, what am I doing now? What am I shifting? But yeah, as you can already hear, there's a lot of different factors to the decisions to inform the decision. So it depends on what age you are, what your goals are, how stable is your income, what are your personal financial obligations, and they really change vastly and vary vastly rather, between people as well. But it is that time in the market. The younger you are, it doesn't matter, like this example here of investing even $100 a month can significantly grow over time to compounding. So it's that eighth wonder of the world, the impact of compounding, compound interest as well, for us always to remember. Just a quick chat around HEX as well. My last webinar was around HEX. And where does this fit into everything as well? Obviously, for those domestic students who, if they do have any HEX debt, it hasn't been bundled into, in terms of that priority listing approach, those steps that I shared earlier. It's not bundled into the consumer debt. It's different because it's indexed with inflation as opposed to having interest. And you only are repaying it if you earn over a particular threshold. That's automatically managed through the ATO. So it's not often a priority to pay it off early. There are other priorities or better uses if you have excess, paying off your consumer debt and then a home loan or your home. And then that frees up all of the extra money that you could use for wealth building, as opposed to paying off that HEX debt. So thanks, Sassini. So some of the common investment mistakes to try and avoid is starting without a financial cushion. So not having that emergency fund set up, even that first $1,000, and then building up to 3 to 6 months. Chasing trends like crypto, meme stocks, FOMO. Don't chase those trends. Ignoring fees and tax implications. So really important when you are comparing investments, particularly stocks, mutual funds, your indexes, all of that. You need to ensure that you don't just make quick decisions and don't make the effort to read and analyze the details. And it does take time, but it literally pays off. So even all of your super funds, the different ways they slice and dice the fee structures are really important for you to look at through running your own scenarios and saying, right, if this amount's going in, How much am I getting charged for that? If I earn this percent, how much are they taking of it? So you really need to there's no quick, easy way to do that. You just need to make sure that you're doing that due diligence yourself, and looking at those fees. Another trip up is often overcomplicating your portfolio, trying to do too many things. You can get that diversification, as I mentioned already, through your managed funds, but they often have a high fee. So looking at, managed funds that are indexes like Vanguard, check them out, see what you think. You can get that diversification at a very low cost, as opposed to, but if you're somebody who really enjoys, investing in a business and having an investment property and having a stock portfolio, do that if you enjoy it, but you want to be making sure you're getting the returns as well. So the key takeaway is to keep it simple. Have that really good financial hygiene of having your emergency funds, paying off all your credit, consumer debt first, having your superannuation fund money going into a good fund that you've researched and you've looked at, and then any extra you're looking at diversified long-term investments. So super covers retirement, but to start building your own wealth sooner. So obviously to bridge any gaps, but also to have extra. Start once you're financially stable. Time and consistency, more important than timing. So small amounts frequently, don't try and time the market. Investing is not just stocks. So yes, you can invest in also things that are, property and businesses as well, but it depends on your skills and your interests. So keep it simple, stay the course. And for all of these, I can see there's a couple of questions that are probably starting to pop into more sort of personalized, individualized situations. Happy to catch up with you one-on-one and talk through some of those scenarios. Not being able to give you financial advice, but happy to kind of help you, support you, sort of think through those decisions or options that you're looking at. If you're wanting, to check the calculations or what your thinking is, happy to be a soundboard and do that. So I guess the key actions are for you to sort of firstly ask yourself, are you financially stable enough to start investing? What's one small step you can take this week? And I would be really encouraging that to be around the emergency fund and also checking out your superannuation fund. Then start to look at what are some of the things if you're ready to invest. Based on what we've talked about tonight, we've obviously not been able to dig deep into any of these in detail. But knowing that, if you've got a particular interest in an asset type, looking at that, considering how you can manage the risk and return, how you can invest in it for the long term, and how you can make sure it's diversified to manage that risk as well. So it might just help you to sort of jump into those. And that brings us to the end. I know you've had a couple of questions along the way, but is there anything particular? I can't give you my top 5 investments, but I'm certainly happy once you've got specific ones to kind of, have a look at those in more detail together. I hope that I've covered off. I'm just checking my little notes again on some of those key things you were looking for to get out of this. I hope that's been helpful for everybody. And thank you for your contribution tonight. Okay, cool. So that's cool. And how's it going, Siddhartha? That's good. And have you got is it invested for the long term? What's your goals with that investment? Yeah. Okay, good. So you'd be wanting to, reinvest all the dividends, any income that's being earned. I'm not sure your comment. I was confused on what's SCHD, so I'm not very good with abbreviations. And just as I wait for your response there, just for everybody else, if the If you've got other questions, please let me know. I was just going to bring up a couple of tools and resources that might be helpful too. So some budgeting ones as well. So if you're wanting to, really get a handle on your budget, which some of you shared you want to increase that, looking at some different budgeting tools. I personally just use Excel, but I'm an accountant and I love Excel. But you can have a look at apps. A lot of the banking apps now also help you to categorize your expenditure and allows you to set budgets. That's another free way to do it. But there's lots of other options out there. So I'd certainly encourage you, if you don't feel like you've got a good handle on that, to look at what is the best tool to support you. There's also lots of options around micro investing, race and spaceship investing platforms that I've mentioned. So Vanguard, Better Shares, Pearl Self Wealth, and obviously a lot of the banking also have their own investing platforms. Some educational stuff as well. Money School, Barefoot Investor is the one of the good Aussie investing literature too that can be helpful. And then our own government ASIC moneysmart.gov.au is also a really helpful resource as well. So that might be some good ones to connect in with. And finally, if you do want to get in touch with me, happy to talk about any of your things that you're looking at, just be a soundboard, look at how you're calculating things, happy to help. Just email skills@scpa.net.au and we can set up some time together via Zoom, work one-on-one. You've got lots of questions there around the different apps that I prefer. I don't use any apps. I have my own perspective on them, but as I said, I'm quite old school and I like things not to be accessible or online on my data, so I just use Excel. But that's my approach. It doesn't have to be yours. It's all about knowing yourself and what works for you. Definitely something that's free. I would not be signing up to something I've got to pay for. I want to use that money to build wealth. But if you really like it, but I'd certainly say a lot of the banks now are brilliant at budgeting and helping with that too. So wonderful. So thank you all for coming along. I hope that's been helpful to everybody. And it's been really nice to catch up with you. I hope to catch up with some of you one-on-one if that's something you'd like to do. But otherwise, we've got another couple of webinars being delivered throughout the next couple of months. So I might catch you in one of those as well. Wonderful. Lovely. Great to hear that you had a great night and you enjoyed it. Thank you for coming along. Thanks so much for your interaction. It was fabulous.